Welcome to today's Explainer. Overnight, it feels like literally everyone on the internet has suddenly become a geopolitical expert, all thanks to the escalating tensions between the US and Iran. But here's the thing, when the global stage shakes, the financial markets rattle right along with it. So today, we're cutting through all that noise. We're going to take a macro to micro look at exactly what this friction actually means for the Indian stock market, and more importantly, we'll break down the exact strategy you need to navigate these turbulent waters.
It's the immediate dilemma, right? It's causing massive anxiety for virtually every investor out there right now. Are we staring down an imminent market crash, or is the market going to just shake this off and rocket to new highs? Look, it's completely natural to feel a wave of panic when you open your portfolio app and just see a giant sea of red after a breaking news alert. You're probably sitting there asking yourself, should I sell everything to protect my capital? Should I aggressively buy the dip? Or do I just sit on my hands and wait? I completely understand that concern. By the end of our analysis today, you are going to have a very clear, actionable answer to those exact questions.
Okay, let's dive into this with a really clear roadmap. 1. The impact of US-Iran tension. 2. The effect on the Indian market. 3. Which sectors to watch. 4. The right strategy for investors. And 5. The market's next direction.
Section 1. Impact of US-Iran tension.
To really understand the stock market's reaction here, we have to recognize one fundamental geographic truth. The Middle East is the absolute epicenter of the global energy supply, period. When friction happens there, it triggers a very specific global chain reaction. First, crude oil prices are instantly threatened by supply fears. Then, shipping routes become hazardous, which causes massive bottlenecks. That completely disrupts global trade timelines, and ultimately, it all culminates in a spike in inflation. But here is the absolutely crucial takeaway for you to remember today. The market pressure we're seeing right now is driven far more by the uncertainty of what might happen rather than actual widespread warfare. The market hates uncertainty, and it prices that fear in immediately.
Section 2. Effect on the Indian market. So how does all this global chaos actually translate down to Dalal Street? Well, we're basically looking at two distinct scenarios. If tensions escalate, expect immediate volatility. Foreign institutional investors, or FIIs, usually flee emerging markets during global crises. Plus, higher oil prices mean a massive surge in India's import bill, which puts immense pressure on domestic inflation and interest rates. On the flip side, though, if diplomatic talks succeed and tension eases, we can expect a massive relief rally, especially in banking, IT, and financial stocks, as foreign trust is restored and capital flows right back into the country.
Section 3. Which sectors to watch? Now, what's really interesting to think about here is how geopolitical events act as a giant sorting mechanism, instantly creating distinct industry winners and losers based purely on their business models. On the positive side, defense gains serious momentum from an increased focus on government security spending. Oil exploration and energy companies, they see their margins expand when crude is high. But on the negative side, where oil is a core cost, the pain is immediate. Aviation suffers from soaring jet fuel prices. Paint, chemical, and tire companies take a massive hit because petroleum derivatives are key raw materials for them. Meanwhile, sectors like IT and pharma have a relatively limited direct impact from oil prices, but remember, they're still going to ebb and flow with the broader global market sentiment.
Section 4. Right strategy for investors.
When the news is flashing red and volatility is sky high, it is absolutely critical to block out the noise and focus on rational, calculated action. The single biggest mistake you can make right now is panic selling on breaking news. Reacting emotionally to sensational headlines and blindly dumping your stocks is literally the primary trap retail investors fall into time and time again. When you sell in a panic, you are almost always locking in a loss at the absolute bottom of a fear cycle.
And this brilliantly illustrates what you should be doing instead. Rather than panicking, run your worried stocks through a fundamental checklist. Does the company have good earnings, a strong balance sheet, low debt? Does it have a track record of consistent profit growth? If your portfolio is built on companies checking these 4 boxes, hold your ground. Strong fundamentals act as an anchor during these geopolitical storms. Let's turn this into a really clear 3-step action plan for when the market falls. Step 1, like we just covered, simply don't panic sell fundamentally strong companies. Step 2, utilize systematic investment plans or SIPs and staggered buying. Whatever you do, don't try to catch a falling knife by investing all your money at once. Buy a little bit at a time. And step 3, keep cash ready. Having dry powder sitting on the sidelines means
If a really big correction hits, you are perfectly positioned to scoop up incredible companies at incredibly steep discounts.
Section 5. Market's next direction.
To cut through the daily barrage of confusing news alerts, you need to bookmark these 5 key indicators. First up, the crude oil price. This is the absolute barometer for this specific crisis. Second, the global market trend, just to see how international investors are reacting. Third, FII activity, our foreign institutions buying or dumping in the Indian market. Fourth, the rupee movement against the dollar, which reflects those import pressures we talked about. And fifth, Indian companies' quarterly results. Ultimately, real corporate earnings will drive the market regardless of the global noise. These 5 specific metrics are exactly what you need to monitor to understand where we're heading in the coming days.
I want to leave you with a really reassuring truth. History shows that strong companies recover from geopolitical shocks over time. Initial market reactions are almost always volatile, and yeah, they're driven by fear. But as time passes, businesses that provide real value, maintain strong balance sheets, and actually grow their profits inevitably bounce back to new heights. So do your research, focus on quality stocks, and maintain that long-term perspective.
So, we started with this exact question, and now I'm turning it over to you. Based on the macro chain reaction, the sector breakdowns, and the fundamental strategies we've explored today, what is your verdict? Is the market going to crash, or is it going to rocket? Apply today's structured analysis to your own portfolio, and let us know what you think. Thank you so much for joining me for this explainer. Keep learning and stay focused out there.